Walmart's asset turnover in 2012 is 2.31. This means it's generating on average $2.31 in sales for every dollar it has in assets. And again, those assets would consist of items such as their inventory, their stores, their distribution warehouses, their trucks, etc. Harley-Davidson had an asset turnover of 0.52 in 2010. So for every dollar in assets, they were only generating 52 cents in sales. And PP&L's in 2010, its asset turnover was even lower. It was only generating 26 cents in sales for every dollar in assets. We would say PP&L is a very capital-intensive industry or company. It has lots of fixed assets in the way of power plants. Think about nuclear power plants, hydroelectric dams, gas plants, coal gasification or coal electric generating plants. These consist of very high capital investments. In 2013, Walmart generated $2.31 in sales for every dollar in assets. Apple in 2013 generated 89 cents, or rather 83 cents in sales for every dollar in assets. In terms of which company is more efficient at generating sales with its assets, that would be Walmart, the higher asset turnover. Which company's asset turnover improved every year? The company with the improved asset turnover would be Harley-Davidson. It went from 52 cents in sales for every dollar in assets to 55, eventually up to 61 cents in sales for every dollar in assets. Which company's asset turnover deteriorated over the past 3 years? And that would be Apple Computer. They were generating 93 cents in sales. Then it dropped to 89 cents in sales, and finally down to 83 cents in sales in the most recent year. The deteriorating asset turnover relates to Apple's rising cash holdings. Recall from our Wall Street Journal articles in the cash flow unit and our cash flow statement activities, Apple has generated more than $140 billion in operating cash flows over the past 3 years. And while it has returned nearly $35 billion of that cash to shareholders through dividends and share repurchases, its cash and investment balances are growing rapidly. And these investments in cash and other investment assets don't do much to generate new sales. And so assets have been growing, little to increase sales, although sales are up by 60% over 3 years, but sales are growing slower than assets, investment, and cash holdings are growing. And so since its assets are growing faster than sales, its asset turnover is decreasing. We're going to find this will help drive down not only Apple's asset turnover, but its return on assets as well. Which company is most efficient at using its sales to generate assets? That would be Walmart, with the highest asset turnover. Which company is least efficient? That would be PP&L with the lowest asset turnover. PP&L has a low asset turnover, but if we refer back to the profit margin exercise, PP&L has fairly high profit margins. On the other hand, Walmart has a high asset turnover, but if we refer back to the profit margin exercise, we found that Walmart had fairly low profit margins, less than 4 cents on every dollar in sales. Finally, does a low asset turnover indicate a weak company? And the answer to that is no. Low asset turnover is just one component, again, of operating performance. Companies, again, use different strategies. Walmart uses very high asset turnover but has low margins, and we see, on the other hand, PP&L has high profit margins and low asset turnover. Both are strong companies.